Hey, everybody, welcome back to Beyond Moon. This is episode 5, and I am going to bring you an interview I had with Mr. Clinton Donnelly. Now, this is a man with an advanced law degree. He is a tax preparer extraordinaire, registered with the IRS. We're going to go into questions that you may want to ask your potential tax preparer, issues to look at, biases to identify. That conversation and a whole lot more insight from Clinton. Enjoy. So, Clinton, thank you so much for taking the time with me today. How are things going?
Hey, well, it's the middle of tax season, but I'm having a barrel of fun.
Right on. One of the things that I wanted to get to straight away was with this series Beyond Moon, and it's been about, preparation, putting together teams, looking at processes and stuff like that. If I were to ask you, Clinton, were not who you are, and you were needing to go out and seek professional help as it pertains to taxation, whether it be digital currencies or foreign investments, what kind of list of questions, what would your process for interviewing the professional help that you were going to bring on to your wealth management team?
I think it's important to find out what they're oriented to. What's their experience? Is this person a stock person? Is he a bond person? Because for him, every good investment is going to be a stock investment or a bond investment, or it's going to be a crypto investment. You're going to find, everybody is a believer in their own thing. So you need to understand the color of the lens they're looking through when they're giving you advice. Secondly, because ultimately it comes back to you to balance the set of risks that you're managing in your investment portfolio. For me, my specialty is in tax. I mean, I know how to make a lot of money. I've done it in my life. In terms of investing, I find that I need other people's advice more than
Right.
me. Creative. Some people are amazing investors. It hasn't followed me that way. I'm not a day trader. Tried it, didn't work. So when it comes to tax, and I think it's a very important thing for everyone to consider, because think about this. You earn some money and the government wants to take a third of it. All right. So you're out there trying to, make a little bit, you're hustling this investment, hustling that investment, but then the government's taking a third. So logically, whatever strategy you're engaging in, you need to seriously consider what the tax implications are and how can I get the best advantage. So I think that's why tax is so critical. A lot of people hate taxes, don't want to think about taxes. They get outraged about taxes. And I'm going to throw out this little tidbit for you, because a lot of crypto investors, in my experience, have had very little general investing experience. So they're not as wary to certain cons that are out there. And one of the big lies is how can I describe it? This kid called me up with his dad on the phone, and this kid had invested in a faucet. And over the time he'd been doing this, I mean, he's in college, he had accumulated a couple of Bitcoin. He invested in BitConnect, which was a scam, and he lost it all. And he was worried about the taxes. So I said to him, we discussed the situation. He goes, "Oh, I'm going to sell everything I have. I don't want to have to pay any taxes." I said, No. You don't understand. Taxes are what you pay when you're making money. If you don't want to pay taxes, stop making money. That's not the solution. I would rather pay, $30,000 in tax and make $100,000 than only earn like 10,000 and pay no taxes. The richest people in the world live in the countries with the highest taxes, generally speaking. If you go to poor countries that have low taxes or tax havens, the richest people are not there. Now, there are tax tricks that you can take advantage of when you have higher amounts of wealth. But for the newly wealthy, these tricks are not necessarily what you want to focus on. I mean, the biggest tax benefit you have is long-term capital gains. So, which is only 15% or 20% at the very highest tax brackets. This is a great bargain. I mean, 20% internationally, that's a really good tax rate. And it's very competitive. And, it's something to be aware of that, so anybody who's giving you other strategies, you need to think about long-term capital gains, which is just the buying something and holding it for a year. Other people want to get you, well, invest in this and then start day trading and flipping here and back and forth, really creative and innovative things. Well, these are all short-term gains that you're going to pay at your regular tax bracket, which might be in the 30% range or maybe a little bit higher. So you need to backpedal and think about whatever advice you're getting from an investment advisor and think, well, what's the tax implication? Is he really looking at my entire financial ramification when he proposes this clever investment?
No, I like that, especially with what you started off when you stated in the interview process or investigation process of your team, to get a fix on the biases that person will have, because those biases will affect the suggestions and strategies that you're presented with. So that is excellent advice. So to give you a quick example, 2 episodes ago, I sat down with Cryptopolis and I outlined my entire exit strategy from crypto, where I took a specific amount of XRP and through a 5-stage process showed how much I would liquidate, what I expected the gross return to be, what I expected the adjusted cost basis to be, and what I expected the capital gain to be on the finished gross to receive a net. Now, that took a taxation formula that I just got off the internet. But dealing with somebody like you, I would get I'd know exactly what I got to do, as opposed to kind of a back of the envelope type of deal. But then and here's where I know I'm going to need somebody like you, because then I have this capital. I want to put the capital to work, and I want to put the capital to work in a way that I will derive an income, creating a whole new set of taxation issues, right? Because with income tax, there are issues. And I know that there are limits within X amount of dollars per year, that if you stay under those, like for instance, my case, single guy, $38,000 a year in dividend income is tax-free. But when you exceed that, now you start getting into da-da-da-da-da-da. So finding the bias that the people that you're interviewing have is important to know. Obviously somebody skilled in the industry that you're seeking the help in. What other, like if I had to list 5 questions, let's say I was going to interview you, you're going to, to be my guy. What would be the 5 questions I should ask you? 1 is, what's your specialty, which gives me an idea of your biases. Let's wrap off a couple others so those at home can take some notes.
What's his specialty?
How they get paid?
Oh yes, you want to know how the commission structure works. You want to know how they're making their money, and you definitely want to look at how they're making the money, what investments they get, and how they get paid from them. Another thing, it's probably not a question as much as something you reflect on after the interview is, okay, am I feeling pushed? Am I feeling I think this is very important. I'd say this comes from Warren Buffett. Do you understand what the investment is? Can you really understand it? And if Warren Buffett, who I'd say is a pretty skilled investor, if he says there's a lot of businesses, he doesn't understand their business. He doesn't understand it. And I think you need to be able to understand the investment. Otherwise, you're a victim. And there's a lot of scammers out there, and there's a lot of smooth talkers, and they're lawyers, they're investment advisors, and especially when you're doing investments that are not SEC regulated, there can be a lot of con men. And it's very important not to put, are they giving you a balanced view? Are they trying to get you to put everything you have into their one investment? Or or are they, respecting your financial position? So I think you need, are you feeling respected or pressured by these people? I think that's key to, listen to your gut on that, not the dreams of great wealth that you're going to make.
No, I totally get that. And I like that. Thank you. That was a pretty nuanced answer. Here's a couple that I would come up with. I'm not in your industry, obviously, but how long have you been in business? That would be a question that I would ask. Here's one that I can ask you specifically.
Yes.
Is there some agency or list or place where somebody in your industry, if they conduct themselves in a way that's unprofessional, they get put on this list? It's a way for me to, like, if I was going to have you be a driver, I would check your I would check your driving record to see if you've been a good driver. Is there such a thing for tax professionals?
Okay, so zooming in on tax professionals, the IRS has a massive problem with unlicensed tax preparers. Okay, so there's no, you could, somebody just out of prison can become a tax preparer with no expertise at all, and he's just going to fraudulently make forms and fraudulently make returns for you. So there's a lot of scammers and that sort of thing. This is a big problem. So how do you get past that? First of all, look for their credentials. If they claim to be a tax lawyer, you want to see a bar registration, that their registration with the bar at the state bar is still current. And that should be something you could find on the state website. If they're a CPA, they're going to be registered to a particular state. Is that CPA registration still current, or has it been pulled? I am an enrolled agent. I have a law degree, but I'm an enrolled agent, which is an IRS registration. It's the highest recognition that the IRS gives to a tax professional. And, I have a certificate with a number on it. The second thing you would do first of all, you want someone to be credentialed, right? If they're not a lawyer, a CPA, or enrolled agent, you're dealing with someone that has not put serious amounts of time into mastering their craft. Okay. Secondly, how can I test to see if, like you just mentioned, are they still legitimate? Well, the IRS keeps a website of credentialed professionals. It's called the Registered Preparer's Office. And if you go to irs.treasury.gov/RPO, you will come to the Registered Professionals Office, and you can type in my name in the United States, type Donnelly, and you're only going to find a few of us. Actually, you look in zip code 77080. I'm the only one there. You'll see me. I'm an enrolled agent. We have to keep that up every single year. There's a small fee we pay, and you have to maintain these qualities. So that would be a key place to go. I have clients in Panama who'd gotten their tax returns prepared because when you're an American, you still have to file a tax return anywhere in the world. So these guys had H&R Block Panama prepare their return. All right, and how at the bottom of the 1040 form, you sign it, and then underneath that it says who the paid preparer was. It has the person's name and their signature. It looks all very nice, right? But if you look at the address was a U.S. APO address for a military base in West Germany. All right. This was a fraudulent preparer. They weren't licensed, they weren't registered, and they had a fraudulent address. H&R Block U.S. does not control H&R Panama, right? Then I had another guy in Panama who was a Canal Zone person. He grew up in the Canal Zone, American, and Panamanian as well. And so he would do taxes for all the Americans. Well, I looked at one of his tax returns. It was very bad because he didn't understand how to do foreign corporation reporting, and he really messed up a lot of things for this taxpayer. They brought it to me, and I was able to amend 3 years of tax returns and get $16,000 back for them. But I looked at his address. Well, actually, the address was fine. Everything about him was fine. But they told me that they always had to mail in their tax return. He would print it out and they would mail it in. Now, hey, you're supposed to electronically file these things, right? The current year return, you should be able to electronically file.
Right.
Why can't he file? Because he cannot pass the qualifications to be an electronic filer. He doesn't have the certifications. I don't know what he did. He dirtied his pants somehow, but he was an unlicensed tax preparer. So you got to protect yourself. They might say a great story, but if they don't have the credentials, if they're not on the IRS website, they're a giant red flag.
No, well, I think that's important, especially with what I believe. Now, I don't have hard data to back this up. This is completely anecdotal, observational, but from what I gather from YouTube and crypto Twitter, a very large percentage of us that are invested in digital assets with a hope of becoming wealthy through them don't have experience being wealthy. And so therefore we've never put together wealth management teams. We've never went out and, hired a Clinton Donnelly or a wealth management outfit or an estate planning tax attorney or any of these things. So I think that's really cool. I'm getting the sense already in this very short conversation that as my time gets closer and closer to me taking action and formalizing my team, you're going to get a call from me, because I love the fact that you have dove deep into the crypto asset space, that you are completely hip with foreign asset investment. These are all things that are going to be in my quote unquote tax world. And not everybody can say that. There are a lot of people out there in the tax preparation industry that are clueless when it comes to outside the US border, and especially digital assets.
That's true. A little bit about myself.
Please.
I had been very successful in life, and I had retired to Panama back around 2010. And I was, being retired is fun, being at the beach is great, but after a while it's boring. So I decided to get a law degree, advanced law degree, specializing in the international financial regulation. 'Cause living outside the US, all of a sudden I became very aware of these international laws. And in 2010, there was also this really significant law passed in the US called FATCA, which was perhaps the most audacious law that the US has ever passed, which obliged every bank in the world twice a year to report back to the IRS the total amount in every American's bank account overseas. It was very audacious. In the process of learning international banking, international regulations, international taxation, people were coming to me left and right because they were worried about FATCA. And particularly in Latin American countries with real estate, you tend to own real estate in the name of a corporation. It's a very common thing in Latin countries. It's kind of like a type of insurance policy. So all of a sudden people realized, I told them, do you realize if you have a foreign corporation, you have to report these to the IRS. Failure to report them is a $10,000 penalty. Oops, and so I realized everybody had these problems. All these Americans in Panama had this problem, let alone having to deal with these two guys that did taxes that were unregistered. So I thought I'd love to help these people. And I could become an enrolled agent and I could represent people. I took the exam, and my first clients were actually up in Toronto, some Canadians, actually they were Americans living in Toronto for 50 years. Never became Canadian, but they had these assets. I mean, they had, oh my gosh, maybe 120 bank accounts. I mean, they didn't believe in putting all their money in one bank and had a lot of money. So I had a lot of bank accounts, investment accounts. It was perhaps the most complicated tax return I've ever done, 250 pages. And it was a crash course in all the complexity of foreign corporations, foreign bank accounts, FBAR, the FATCA form, which had just come out, the PFICs, which are passive foreign investment corporations, not to mention foreign earned income exclusion and foreign tax credits. You know, so since then, I wrote a book on foreign earned income exclusion, which would be probably of interest to you, which is a 320-page book on taxes, which I have to admit is probably the most boring book you'd ever want to read, unless you happen to be earning money outside the United States. And then it's a page turner, right? I mean, I've had guys say they've read the whole thing one day. It was so interesting, right? So, and it's still the only book out there on Amazon. So since then, I've written 5 other books. Actually, it gets a little bit looser, you know, a bunch of others, but 5 books on cryptocurrency tax preparation. I got into cryptocurrency tax preparation at the beginning of 2018. And I had lots of friends, international, that had purchased cryptocurrencies. You know, in 2017, they all had the run up, right? And I was not an investor at the time, but, you know, I was intrigued. And I was intrigued about the tax aspects. So I went to work for part-time with a company that was specializing in crypto tax return preparation. I was helping them explain it to people. They taught me the principles, and I was explaining the principles because, hey, you know, I was a enrolled agent. I had the law degree. The guy that was mentored me left 2 weeks after I started, and I became the legal expert in the company. So, you know, you learn things when you're under pressure.
Sure.
I learned a tremendous amount of things, and listening to people's stories. I must have talked to 700 people and their situations and their stories, and understanding that was like a crash course in how cryptos work. Everybody told me the crazy stories. But eventually I decided they couldn't deliver the type of quality they needed, because I was explaining to this company that, you know, you have foreign exchanges. You have to report these on the foreign bank account report, FBAR. You have to report it on the FATCA form, 8938, it's an IRS form. And failure to do this is a $10,000 penalty for people, you know. And so I knew these things. I knew tax amnesty before I even came to the crypto field. And what is so amazing is that people who may have grown up and lived in the United States, had never done anything foreign, all of a sudden they're investing all over the world, and they're tiptoeing into these foreign filing requirements that sadly most U.S. CPAs and tax preparers are oblivious to. So this is my orientation, how I came at it. And, you know, I think the anti-money laundering theme is a very important regulatory theme we have to be aware of when it comes to cryptocurrency. So, you know, in terms of questions you want to ask professional, you want to know how familiar they are with the FBAR forms, with the foreign filing regulations. And if they're the more drilled down question is, how many have you done? All right. Everybody's listened to a webinar, you know, but how many have you actually done? You know, and that, I think that gets to the heart of experience for somebody.
Wow, great. No, that's wonderful. And there is a lot to unpack right there. You know, that brings to mind a couple of things. One is, for instance, ¿Cómo es tu español?
See, poco poco.
Oh, poco. I asked him, how's your Spanish? He said, little. Yeah, mi español es muy malo. And the other here is that, to me, it would seem, as I'm a student of this game, with the advent of tokenizing assets and the ability for these borders to just kind of dissipate when you're dealing with exchanges. If I'm buying tokenized real estate in Tokyo, I'm actually an investor in a Japanese asset, therefore I have a foreign investment. Yes. And I think I'm thinking to myself out loud here, what a growth industry you are sitting in. You know what I mean?
Yeah. Hey, what we're seeing is globalization hitting the life of the everyday investor in the U.S. who's never ever dealt with, you know, globalized investing. And at the same time, we're wrestling with how to characterize, and it's not me, but really the tax profession, not the government. The IRS is trying to figure out, how do we treat cryptocurrencies? They came out in 2014 with just I'd call it a stake in the ground that cryptocurrencies are property. They have a cost basis, they have a sale price. The difference is a gain, your taxes on the gain. Right? That's that was a pretty good stake, but we're at the point now where we realize that since 2014, the way blockchain and really the whole fintech technology is going, it's just doing more and more things. You talked about tokenizing, we're also getting into other aspects of DeFi that just are turning the tax law on its head. I mean, we're stretching and twisting nuances, which mostly the vocabulary in the tax law is around stocks, bonds, real estate, commodities like livestock. These are the pigeonholes. But a virtual asset, it has, we're not used to. The tax law is challenged when, if I have a cow and I want to sell a cow for 2 of your sheep, well, that's easy to understand. But with cryptos, what we're doing is I'm cutting off the cow's tail and I'll swap it for 2 of those ducks. And so what's the basis for those ducks? Well, it's a tail. Well, what price do I put on the tail? What about the rest of the cows? It's still a cow? And we're cutting up assets and trading them around. And this isn't visualized inside the tax code. The IRS has no way to really handle the type of granularity we're coming up with. All they can look at is the gross. What is the income? And even that's challenging for them. So, especially as we get into forks and airdrops and all these things that are, they just don't happen with livestock or real estate or stocks, period. So we're really wrestling with a whole new asset class. And I believe that the IRS has been slow to put forth guidance, primarily because they're still waiting to see what cryptos become. The IRS has all the time in the world. All right. They don't have to answer the questions now because the crypto world today is going to be much different than it's going to be 5 years from now. We'll be doing amazing things crypto wise that we can't even visualize right now. So, and the tax law has to evolve and grow with all that. So there's no reason to rush for the regulations.
And with that being said, it appears they're being proactive, at least from where I'm sitting. For instance, here's a great example. I'm on Twitter yesterday or the day before. Here's a tweet from Clinton Donnelly, which, by the way, on Twitter, every time you tweet, I get a notification. You're one of 5 or 6 guys that I've actually turned on the notification so that when you tweet, I see it in my notifications. I can go right to it and see what you were talking about. And this was either yesterday or the day before you had tweeted that the IRS just had like a seminar, a conference. And you had a blurb in it. I can't remember the blurb, but it told me that you're staying right on top of this. What did you glean from this most recent IRS seminar, workshop, conference thing that just happened?
Well, that summit was a one-day summit. They brought in crypto professionals. I was not there. But they basically had 4 major presentations, but also as a networking time, right? Here's why, in my opinion, that summit happened, because the IRS fell on their face multiple times, and it's apparent that they fell on their face because they were not engaged in a dialogue to truly understand what the cryptocurrency financial world was like from a tax point of view and the ramifications of the ideas they had. They were kind of sitting on their ivory tower and came out with some guidance that was that immediately got attacked because it was not fully thought out. So that's why we had the dialogue. Hey, so the IRS came out with guidance 2014, which basically said, here's what cryptocurrencies are. We're calling them virtual currencies, treat them like property. Here's the ramifications of it. Then they didn't say anything until 2019. The Joint Commission on Taxation from Congress basically wrote a letter to the commissioner and said, you need to give better guidance. And they had, he said, yes, I'll do it. When he finally came out, which was, October of last year, right? Not very fast. It was something like 45 frequently asked questions, and then they had what they called a technical ruling, which was like a particular on a hard fork and an airdrop. It's a very, let's say it's how can I say it? It's a fictional airdrop, is a fictional case, and they came out with this guidance that basically said, the moment you get the airdrop, that's considered income right then, and the rest of it's investment. Well, that didn't match what the questions people are asking, because everybody bought these ICOs and got these airdrops of ICO things in late 2017 that became worthless, and they're very upset that they would have to treat them as income right away, so they didn't really tease out that nuance. I mean, I looked at it and I go like, this is useless, because elsewhere in the fair market value is defined as what a knowledgeable buyer and a knowledgeable seller would exchange something for if they had a free market. All right, it comes from the Internal Revenue Code, Section 170, and in that on that basis, there was nobody buying these ICOs when they came out. They might have said it had a value, but there was no exchange to trade them on. Nobody wanted them. These airdrop things, there's no market, so the real street value was zero. But what the IRS came out with was just useless guidance. And then they came out with this frequently asked questions, which under the IRS guidelines, frequently asked questions are non-binding. They're non-binding, right? So they could completely disavow anything they have in there on a particular audit. Okay, so what's that, right? What guidance is that? You're basically, I don't know. It is embarrassing. The General Accounting Office, a week before this summit, had come out with a finding that the IRS had failed to give adequate guidance, particularly related to the FBAR and the anti-money laundering forms, and that they needed to give better guidance. And they gave this to the IRS to comment on. The IRS said, we're not going to give it. All right, so which is very shocking at the time. Now, since then, and then the week afterwards, we had the IRS summit. The other thing that happened during the summer of 2019, the American Institute of CPAs, the major CPA organization, had their annual meeting, and they invited, it wasn't in the summer, I guess this must have been like in November. They invited the woman, and there's a woman and a guy from the IRS Chief of Counsel's office, to come and present about cryptocurrencies to all the, the national meeting of CPA. It's a great forum, right? They presented basically this FAQ and ruling that they'd come out with. And then they had an open discussion, a Q&A. During the Q&A, the woman, and I won't bother to mention her name, but it's out there, she came out and said that like-kind exchange is not allowed, that the IRS won't allow it. And then there's another thing she said, I can't remember off the top of my head, but the next, like 3 days later, the chief counsel's office had to come out and disavow the comments that she made, and had to say, no, we handle things on a case-by-case basis, until she stepped on her, she embarrassed herself, all right? And she got ripped. Of course, she got ripped about the airdrop ruling. So, and the reason is because they weren't listening. They weren't listening to the community, all right? And they did float certain ideas to the community to get a general reaction. And, it was good for them to get the feedback. It's really, it's good to get the feedback. But what we have since heard is that Secretary Mnuchin had to step in and state that they were working on new guidance related to the anti-money laundering forms, so that was forthcoming, and they expected it that would typically be within 2 months. So I would expect it, by end of April, I suppose. Now, whenever the government says they're coming out with new guidance, it doesn't mean things are going to get easier. Okay, so new guidance means there's going to be more work to do, but it is an important aspect that the government's wrestling. Completely wrestling. They don't want to over-regulate with taxes a market that is transformational, because ultimately one of the biggest industries in the United States is the financial industry. It's a massive, massive industry. We are the biggest financial market, and they don't want to crush it. So, you know, the Goldman Sachs, the Citibank people, they're all putting input into how this is going down. They're all thinking about it. You know, ultimately, we can see a future where the U.S. dollar is digitized, and other currencies are digitized. You know, and they don't want to crush that too early. So, because they don't want to allow other countries to get technological advancement over the U.S. because they allowed more open financial discovery opportunities. Long answer, but that's my insight.
I totally appreciate that. And, you know, so there's a lot to take away in that and unpack in that particular segment. Here's something I'd love to ask you, because this is your field. This perplexes me. There's a part of this I don't understand. I'm coming from a common sense perspective. You're coming from an educated practitioner perspective. And that is this question. How did they establish, and why, this point that something becomes value to be taxed? And I'll give you the scenario. I've taken $100 that I've already paid income tax on, all my stuff, right? So it's post-tax money. I invested in a digital asset. Maybe that particular asset, we'll call it Bitcoin. That appreciated in value, and I traded that Bitcoin for another digital asset, let's say XRP. Now, no US dollars have ever, you know, nothing was turned into US dollars. It was crypto to crypto. That XRP value gains over a period of time, and I trade it for Ethereum. Now, at no time have I realized in my possession a US dollar, but I have an appreciating, you know, this asset has been appreciating. From what I understand, the IRS looks at it every time I've traded up and gained value, it's the gain of that value, or the minus my cost basis, that is a taxable event. That blows my mind. I don't understand that from a common sense, logical perspective. Is there some light you can shine on that for me so that I don't stay angry with the tax code?
Well, I'm trying to figure out, you know, how to explain this. Let me first say that the tax law, and I believe this is section 61, where it's always said with capital, regards to capital gains, and capital just means property. Okay, so a gain, and when I say gains, sometimes it's a negative number, right, or a loss, but we just call it gains. So when you have a gain, that the income, which is the sale price, minus the cost, all right, is the profit. So you have a profit that's taxable. And in the tax code, it's always said whenever you sell property, and it doesn't use the word sell, it says sell or exchange. It's said this for decades, sell or exchange. Well, there used to be a section in the tax code, it still is, 1031, which is also called like kind exchange, where I could sell one type of property for another property, or swap it, if you will, and not have to, and they defer the tax on that gain under like kind exchange.
In real estate, they call it a stalker exchange, a 1031 stalker exchange.
Exactly. Now, the concept is that there is a taxable gain, but we're not going to impose the tax at this time because it's a like kind exchange, right? Now, and what's interesting to me is most crypto traders felt this, particularly about their gains in 2017, when at the end of the year, people said, how do I pay the taxes? And they go, oh, you know, and they heard about this like kind exchange, and everybody said exactly what you said, Jerry, which is, I didn't take anything, why shall I be taxed for it, right? Well, like kind, what you're basically saying, now, from an accounting point of view, we would say you made a gain, all right? You started the year 2017 with like $10,000 worth of coins, and you ended the year with $1 million worth of coins. You had a gain, all right? You haven't cashed it out, but you've had a gain, all right? So they're just saying, but we can defer that gain until your next trade when it's not like-kind exchange. But this is, everybody emotionally agreed with this, all right? Like-kind exchange, it makes sense. Now, out of the blue, the tax law was changed at the end of 2017, and this piece of code, which had been in there for 90 years, was changed to only apply henceforth to real estate only. Okay, and I do a lot of recalculation of like-kind exchange for clients all the time. I believe it's legal for cryptos up until that time, and I save people a fortune. I was just doing work for a guy. We saved him. He avoided $121,000 worth of gain, which is about $90,000 in tax and penalties that he avoided. So I'm saving people big money by doing like-kind exchange, and now the IRS changed, and the reason I'm trying to think, why did that happen? Because nobody was clamoring for this. All of a sudden, that piece of the code was changed. What I believe happened comes back to the chief counsel office at the IRS, and I think they said, we cannot argue in court that cryptocurrencies are not eligible for like-kind exchange. We can't win that argument. There were, and we've done the research, 1,400 court cases on this Section 1031, and there were a bunch of them that applied to intangible properties. Suffice it to say, here's a law that over 90 years has been twisted and stretched and nuanced, and it has gone from physical property to intangible property, now to virtual property. The whole language is so contorted that I think the IRS court said, we can't win if we don't change this law. We'll never be able to argue crypto to crypto again. And what would happen is that people like you, Jerry, would just trade crypto to crypto to crypto to crypto to crypto until you're 90 years old and cashed out. All right. So they would never be able to tax it again unless they did something. And what they did was make it so only real estate could be treated that way. That's my speculation. I think there's a lot of merit to it.
Well, possible to me.
But the thing is, you did make a gain, Jerry. I don't know what your numbers were, but you made some gain. And because you made a gain,
Clinton,
made a gain, it allowed you to buy more, right?
I hear you. However, it isn't a gain unless it's in my hand. If it's not, it could go, if your money is in the market, it can go up and it can go down.
So this might help.
Take the money out and have it in the form of money, it's not a gain. You're
right. So I have some Bitcoin, right? So you have some Bitcoin today. What's it worth? Well, right today it's
Let's not talk about that.
We're not going to talk about today. I'm not having a good day. I bought some Bitcoin. I bought it for $4,000. All right. And now here I am in the future. I want to sell it. What's that Bitcoin worth? We don't know. All we know is I bought it for $4,000. I don't know what I'm going to sell it for in the future. I could try to sell it tomorrow. I don't know what I'm going to get. So there's no gain on that. Now, so tomorrow I sell it and exchange it for XRP. It turns out I can exchange it for what was kind of maybe $10,000 worth of XRP. So I actually locked in a gain. All right. I realized the gain. Now I have not, although I realized the gain, I did not receive a payout from it, because what I did was I totally reinvested the gain into the XRP. All right?
So that is the crux of this whole of like where I'm coming from, my discontent around it is you're saying with the acquisition of the new asset and that new asset's valuation being higher than the previous asset's valuation, regardless of time in between, was the gain.
It was the gain, and you realized the gain. It was not yours until you actually did the trade, and then you realize it. Now, the problem, and this is kind of that point I was talking about, when we come back to stocks and how the tax law is kind of twisted. If I had Google stock and I said, I want to swap all this for Apple stock, right? Because my Google's gone up and I want to swap it for Apple, I cannot just find somebody who has Apple who wants Google and do a swap.
Apple to Google pair.
Yeah. I have to take that Google stock, sell it for cash, take the cash once I get it back, and then buy the Apple. So now that's the way it is today. I would not be surprised in the future when we have tokenization of
Right.
stocks that you couldn't do what we're already talking about, for the
Okay.
stock market. It had the same thing. So now if I said, if we look at, I mean, you'd agree with that scenario with the Google. I have to sell the Google. Yeah, you made a profit. You pay taxes on that. Then I buy the Apple, and at that you feel that, yeah, there's tax, there's gain. But now let's say I've tokenized the whole thing. I do the exact same trade, but now I'm doing a swap between the two. It's not going to cash anymore. I've achieved the same result. All right. I just
No, I
never
get
went to
your point.
cash, and that's the
I
tax.
hear you. Maybe, maybe part of where I was coming from is wishful thinking. Part of where I was coming from was not understanding that particular principle of, at the point of exchange, the degree of variation between asset value and asset value is the crux, not the fact that you get cash in your hand. It's the
Right. You realize some
valuation element. Okay, I get that. I totally get that. Man, this conversation could go on for 2 hours, because you're extremely engaging in that way. But I want to respect your time, and so if we were to, let's say, 5 more minutes, what are some points that we haven't discussed that you'd like the audience to have in their bank of consideration as they begin to formulate their process for putting together their wealth management team? And speak specifically as the tax guy.
Okay. This really ties on just to what we were talking about. Okay. It's a very important lesson to realize that every time I sell an asset, I have a tax implication. So, and that can be kind of hard sometimes to figure out how much it is, but you need to, when you sell an asset, if there's been a gain, you're going to need to set aside money to pay taxes on it. All right. And this is what happened to traders in 2017, these massive gains, but nobody set aside any money. And so, they had to do the taxes the next year, and the prices had collapsed. They had a heart attack, right? When you set aside money, you want to set aside that money for the taxes. You want to set it aside in dollars. You don't want to set it aside in something else that's speculative. Now, maybe US dollar tokens would be fine, but but you want to do that. Now, the second thing would be, when I'm selling an asset, you want to think to yourself, have I held this asset for more than a year? Because if I am, then I get to take advantage of a tax break, the biggest tax break for capital assets that the Congress has put in place, which basically says, well, if you sell an asset short term, with less than a year, then that profit that we just discussed is taxed at your marginal tax bracket, which is 20% or 30%, and plus there's a NIT tax that kicks in many cases. We did a lot of another like 3.8%. It's a lot of tax. But if you hold it long term, the tax bracket drops down to 15% for all but the highest earners. 15% is like half, right? So that's a major. That tells you how much to set aside in cash. But you might want to hold an asset maybe a month longer so that you've held it for a year before you sell it. Okay. So this is a massive this is the biggest tax break people need to put their hands on. Am I doing short-term or long-term? And then whether I sell short or long-term, take some money, set it aside to pay your tax bill. You need to pay taxes on a quarterly basis, and just do that so you don't have a cash flow problem when the tax day comes.
Right. Well, one of the things I advocate is have an understanding of exactly the parameters in which you're working with. You discussed short-term capital gains could be as high as 33-40% depending upon your tax bracket. Long-term capital gains 15%. So when I'm looking at, like, for instance, an exit strategy, and I'm saying I want to net, when it's all said and done after tax, I want to net this amount of money, then I reverse engineer using the parameters that you just outlined what I'm going to need to set aside for the IRS. ahead of time so that I know if I need to sell gross amount, I can guarantee I'm going to have this taxation liability. I have this cost basis element. Then I can come up with the final number of the net capital that I'm going to get to work with after I've paid my taxes. I used to make this mistake as a young man where I always thought everything in gross. My brain thought in gross numbers, but we live in a net world, you know, after all the intermediaries get their little piece of the pie. And so once I got hip to that new line of thinking, it sure did make speculating with what I was going to need and what I was going to do a lot easier.
That's a great point. You know, I hear these guys on YouTube all the time, you know, these ads that you don't want to look at. You know, they go, I just made $2 million doing this and that and the other thing. Well, when they say $2 million, they're talking about the proceeds, the revenue. They're not talking about what their expenses are. They may have lost money. You don't know.
Tax liability,
right? But they're, you know, you always push into that. Well, how much did you keep? How much did you know, out of that? So
exactly.
That's a fantastic lesson to learn.
It is. It really is. Thank you. Thank you from the bottom of my heart, taking your time to spend with me today and to help all these, you know, crypto enthusiasts and stuff kind of get a leg up, because we're not always going to be in this bear market. You know what I mean? The world around us is still moving ahead. Regulations are coming, infrastructure is being built, and good times are ahead. And it's no time like the present to get prepared and be ready to execute a plan. And you're an incredible man. Thank you for taking your time with us here today. I want to thank all of you for tuning in to Beyond Moon. We look forward to continuing to bring you good content so that you can better prepare yourself to one day be one of the crypto wealthy. Until next time, everybody, Pura Vida.